Well, it's here. We've now got a pretty ugly scenario for North American trade. Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Council. It's Monday, February 3rd. Welcome to our Global Markets Commentary. Global equity markets had made it through January in the green, but the positive start to the year is in jeopardy as the U.S. launches its initial salvo of tariffs. The tariffs themselves are disruptive, but how businesses, consumers, currency, stock, and bond markets react will be with the requisite amount of uncertainty that comes with any shock. This situation has a unique layer of additional ambiguity that calls for extra vigilance against emotional reactions. Is this still just a negotiating tactic? Will legal challenges be launched? What influence can public or corporate backlash have on the situation? Our advice is to remain calm. Panicked, knee-jerk reactions to any market calamity are never the best course of action. Here are our quick takes on the implications for major asset classes and our advice for investors. The Canadian dollar has already depreciated roughly 10% since early last year. BMO Economics forecasts that a US dollar will cost $1.49 Canadian by autumn. Equities. For investors, parsing out the combined impacts of tariffs on corporate earnings is the bottom line. The impact is negative. However, global equity markets enter this period of uncertainty on decent footing. Earnings growth expectations are solid, and recent reports are surprising to the upside across much of the world. Valuations in non-US equity markets aren't overly onerous. Some are quite low, like China. Tariffs are a disruption, and disruption has been the name of the game for 5 years or more. Corporations have become quite skilled at navigating challenges, particularly supply chain challenges, including the 2018 trade war, COVID shutdown and reopening, and the war in Ukraine. Add in cracks in the US banking system, remember Silicon Valley Bank failure, inflation's spike and retreat, coupled with a coordinated global central bank tightening cycle. All of this has made businesses on both sides of the border hardened and more resilient and better able to meet this new challenge. What about bonds? We expect bond yields to decline on demand for safe haven investment, the prospect of an economic slowdown, and these expectations of the stepped-up Bank of Canada easing. Our advice: no knee-jerk reactions. We rely on diversification. Discipline, patience, and balance are key to navigating periods of heightened uncertainty and market volatility. Well-diversified investors need to remember the role various assets play in their portfolios under current circumstances. U.S. equity exposure brings U.S. currency exposure. These investments remain compelling on their own merits, with the additional benefit of a currency offset to Canadian investors at a time when the Canadian dollar is under pressure. The Canadian stock market is not the Canadian economy. Tariff threats conjure up images of steel, forest products, foodstuffs, and auto parts. While these are important to the Canadian economy, their weighting on the Canadian stock market is minimal. These industries combined are a low single-digit weight of the S&P TSX. The big weightings are metals and mining at 12%,